All right, so moving on to adverse selection. So this is about when one party knows more about the characteristics of the good than the other. So in this case, or kind of the situations that we're looking at, this arises when the seller has more information about the good than the buyer. And so we can think of lots of cases where this is going to be true, right? If you're selling a good, you likely have kind of more information about the quality of the good, or if you had to repair it a lot, I guess that's related to the quality or something like that, right? So a classic example would be the market for cars. Market for used cars, I should say. And this is captured by a very famous paper called the lemon market, or the market for lemons. So a lemon is once in a while some products were just called what we call lemons. They just seem to break down, even if the product in general might be fairly good. Sometimes there's this variance in quality, and sometimes you get a lemon, one that just is a really low quality. So in the market for used cars, the person who's selling the car probably knows more about the car than the person who's buying it. And this can create inefficiencies in the market. So the person selling knows more about the car, the used car, than the buyer, potential buyer. And this can create some inefficiencies in the market. So for example, if you figure out that your car is a lemon, and you figure it out fairly quickly, you're likely to want to sell that lemon. So owners of lemons, and by that I mean lemon cars, like they're poor quality cars, are more likely to sell their car. So they're more likely to sell their car as a used car. But that means potential buyers know this, right? They know that on average there's likely more lemons on a used car lot than there are non-lemons, or in relation to like the percentage of lemons in all the cars. And so what they're going to want to do is they're really going to want to lowering their expectation of the quality of the car, which means that they're going to lower the price that they offer. Well, all of a sudden that means people are going to start to make this assumption that lots of the cars on the used car lots are lemons. Or lots of people that are selling their cars, they're selling a lemon, which means they're not going to offer a high price. And it means people who have non-lemon used cars are kind of less likely to put their car up for sale, because everyone's going to assume it's a lemon, and so they're not going to get a fair price for it. This is also true in things like health insurance in the U.S. and things like that. And what makes it so difficult is that people who are more likely to buy insurance are people that kind of know about the characteristics of their health. They know if they're relatively healthy, if they exercise, if what their diet is, and things like that. And so if they know that they're fairly unhealthy, they really want to buy insurance. But that means that people who want to buy insurance are kind of, on average, less healthy than the rest of the population, which is going to kind of raise insurance rates. And that's going to scare away people who are relatively healthy. They don't want to buy insurance. It's too expensive. The deductible's too high, or the premium or whatever is too high. And this is going to, this is why it's really hard to create health insurance, and why in Canada, when we have kind of universal health insurance, we kind of spread the risk through our entire population. And so, the pool of people in our insurance, our health insurance, is everybody. So we see this a lot in the real world. And so this is going to create these inefficiencies because, these markets can kind of collapse or not be as efficient as possible because people might not, sell their used cars, and people might not buy health insurance because the people who have it are kind of less healthy than average, and so the premiums are really high. But now let's talk about a couple solutions to this problem. So, a couple of different solutions to this adverse selection problem. The first is going to be what we call signaling, with one L or two, I guess. So this is when the informed party, so the person who has more information, kind of gives some kind of signal of what type they are, or like what type of good. Oh, this is a high quality good. I'm going to signal that to you through some kind of costly signals. There's some costly way of me showing you that this good is high quality. So this is when the informed party, this is an action by the person who has the knowledge, gives a signal. Oh, need an L there. To reveal private information. So for instance, sometimes in terms of that used car example, you get a free inspection, or you can take it they'll pay for you to take it for an inspection, an engine inspection or something like that, right? So they could provide an inspection of the car. They could provide warranties on the product. So that's a way of kind of indicating the quality of the product. Oh, I know this speaker is expensive, but I'm offering you this great warranty. So that if the quality isn't what you thought, or a refund or whatever, like if the quality is not what you thought, you're going to get like a refund or you're going to get a replacement or whatever it would be. One of the theories of education, there's kind of two broad theories of education that we can use with each other as well. But one of them is about human capital, that you're going to school because you're accumulating knowledge that you're going to use in the workforce and that's valued in the workforce. Another is that really what school's about is, there's people of differing ability, and it's less costly for people of higher ability to complete more school. And so by completing more education, all you're doing is kind of signaling to employers how, your ability, that you're a high ability person because I went to, I completed high school, or I completed university, or whatever. So that's one of the theories of education, that all it is a signal to employers that you're smart. Two, so that's signaling. That's one of the solutions to this, is for the informed party to give information, to signal information to the uninformed party. Now it's from the other side, is the other solution, where the uninformed party is going to screen the informed party. So it's going to be screening. This is where the uninformed party, so the other person, uninformed, a mash of M's and E's there, informed party, performs an action to reveal private information. So, on the other side of that, they could demand an inspection, demand/require an inspection. Oh, that's supposed to say inspection. So they say, well, I'm not willing to buy this car unless you're providing an inspection or you're providing the Carfax. So a firm that's willing to provide all like the Carfax or whatever those things are called would be signaling the quality type. A person who says, I'm only going to buy cars that will give me their Carfax and the history of the car, that's a screening mechanism. So another one would be you want this low rate of insurance. Well, I'm going to make you get an app on your phone, or car insurance. I'm going to make you get an app on your phone that's kind of going to judge your speed and see if you're slamming on your brakes a lot and things like that. And if you're willing to put that in your car, then that's kind of me screening that you're a certain type of driver, or at least you think you're a certain type of driver that's not engaging in certain behavior. Another one would be job applications. Some job applications require a degree to apply, or that's one of the minimum requirements, even though a university degree might not be necessary to complete the job. Well, this is these companies' way of maybe screening applicants, because this is a way of saying, well, we only want applicants with certain kinds of attributes, and those attributes might be more common in people that went to university or high school, or whatever education level they want, like GED in high school. So these are the two possible solutions to this adverse selection issue.